Hello and welcome. I'm your host, Alex, with another episode of Economic Insights. Our very special guest today, Selim, a market veteran of many years and the producer of our show, is also with us. Welcome.
Hello, Alex. Great being here.
We knew it was going to be a busy week. We knew we could have lots of market movement. But we didn't expect this, right? What a week of drama.
No, at least I didn't. Judging by the reactions in the markets, very few people did either. The most important and shocking part was the massive shift in tone we saw from Europe and specifically out of Germany. It was truly momentous.
Yes, indeed. First EU and then Germany announced a significant shift in their fiscal stance. Tell us a bit more about that.
Germany is embarking on a major fiscal expansion, primarily focused on defense and infrastructure. The plan rests on three pillars, the most important being a spending plan of 500 billion euros over the next 10 years. European Commission also announced fiscal plans named Rearm Europe. This is expected to mobilize 800 billion euros for member states by triggering escape clauses from fiscal rules. Both plans combined was a historic shift in Europe's thinking.
Markets definitely thought so too.
Yes, Alex. Markets were caught off guard by the size and swiftness of these policy moves and reacted aggressively. German bond yields jumped 31 basis points in a single day. Equity markets and euro rose sharply as a result. It is hard to disagree with these moves, to be honest. Growth in Germany can be boosted by 0.5% this year and 1% next year, depending on how fast the implementation is. With this upside growth potential, obviously comes an upside risk to inflation as well. ECB will be watching carefully to how these forces play out.
They had their meeting this week and they cut rates by 25 basis points. But what other messages were there?
The ECB changed its assessment of its monetary stance from restrictive to meaningfully less restrictive. Perhaps the addition of the word meaningfully is more potent. Given the changes they made to their inflation and growth forecasts, I believe the size of the total cuts for this year, as well as the timing, is fully open to question.
The euro must have liked all this.
The euro loved it. It jumped 5% to an intra-week high. But more importantly, the thinking by market players seemed to have shifted, giving a structural boost to the currency. The German 10-year yield was higher by 50 basis points at its peak. The curve also steepened sharply. All of these are helping the euro sustain its strength. Let's not forget the big divergence in equity markets this year either. The spending plan was an obvious boost to the sentiment in German markets, which have risen over 15% so far this year. On the other hand, S&P fell nearly 2%, and the Nasdaq is down nearly 6%.
Can anything go wrong? I mean, we are not accustomed to Europe and Germany making such big changes so fast.
Yes, definitely. First of all, expect the EU initiative to move slower. That's how things work there. In the case of Germany, deliberations start this week. For the changes to pass, the incoming coalition needs the support of the Greens, which is not guaranteed. But the public opinion seems to be overwhelmingly in support of the plan. Therefore, passage of the plan is expected to proceed.
Let's head over to the US now. Can you summarize the developments there?
The most mild way of summarizing it would be to call it chaotic.
Ha 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 ha.
Tariffs on Mexico, Canada, and China briefly went into effect as planned, and then they were postponed for Canada and Mexico. Car manufacturers got a reprieve, but this was, quote unquote, the last time. This back and forth in terms of tariff policies is hurting the sentiment.
We had the sentiment surveys this week. What did they tell us?
While the numbers did not look as bad as feared, the devil is in the details. Manufacturing PMIs in the US point to front-loading of activity. However, new orders, production, and employment all declined. Services PMI in the US improved in February, but the business activity and new orders measures in both the PMI and ISM surveys also indicate a slowing in first quarter growth. Globally, the situation is similar as well. The implementation of US tariffs targeting Mexico, Canada, and mainland China is affecting the manufacturing sector in the near term. Eurozone and UK manufacturing sectors showed signs of deterioration.
How about the non-farm payrolls? We'd thought that would be the big news flash.
Well, it wasn't a big news flash, but maybe that was a good thing. The market had started to fear the worst, and because it didn't get realized, there was some sort of relief, you can say. But again, the details point to a lower growth. Unemployment was rounded down to 4.1%, from 4.14%. Work week remains low. ADP figures and challenger job cuts, which came in above 100% over a year ago, made ugly headlines throughout the week.
We had some news out of OPEC Plus. Could that be good news for the consumer?
OPEC decided to unwind voluntary cuts from April, but they might pause if fundamentals worsen. It is a risky move for the oil producers, given the bearish sentiment in the market due to tariffs. And a lot depends on compliance. That has not been a bright spot in their report card. But yes, lower oil can mean more spending power for the consumer.
And how are emerging markets faring in general in all of this?
Emerging markets have been volatile, being pushed in different directions due to the significant volatility in US economic policy changes and its impact on the Fed expectations. An increasingly softer Fed pricing has been positive for EM in general and has helped the currencies stay more resilient. Germany and Europe's spending plans could significantly impact the CE3 countries, pushing growth and yields higher there.
How about Turkey? It was a busy week for them.
Yes, Alex, first was the CPI release on Monday. It was softer than expected, but service sector inflation remains sticky, and this was something the CBRT acknowledged in the rate setting meeting. They cut 250 basis points as expected, but the statement was seen relatively hawkish by market players. Also, when you look at the currency market developments there against the US dollar, Turkish lira fared well, but against the euro, the depreciation has been much faster, so it's harder to talk about real appreciation helping the disinflation process.
Wow, this was a busy week indeed. What should we be looking forward to next week?
Perhaps the most important data point will be the US CPI. This could be the first month where we start to see the effects of tariffs. Analysts are closely monitoring core goods to identify any signs that tariffs may be impacting consumer prices. We will also get the Michigan surveys, which will be key to gauge if the drop in consumer sentiment continues. Jolt's job openings will also attract some attention. And let's not forget the South African budget is due on the 12th of March.
And I am sure there will be plenty of drama on the political front. A government shutdown in the US is on the cards, isn't it?
Correct. There is a proposal that was released on Saturday, which will keep funding the government until September. This is expected to be voted in the House on Tuesday. Senate vote may be tough. 60 yes votes are needed, and this will require moderate Democrats to go along with the proposal.
Excellent. This has been a great conversation as usual.
My pleasure, Alex.
Folks, we came to the end of another show. Thanks for tuning in to Economic Insights. Don't forget to subscribe for more. And don't forget, folks, this is not investment advice. For that, please consult a professional. Until next time.